Welcome back, you legends. I'm Dr. Cal, and let's get right into it. Up top is the S&P 500 monthly chart. Down below is the 2-10 yield curve. And what this chart highlights is what happens exactly after the yield curve inverts and then begins to normalize. And each time this has happened, going back 100 years, 11 out of the last 12 times we had a recession, and each recession saw anywhere between 30% and sometimes even 90% declines going back into the late 20s and 30s. However, in the last 25 years, what we saw was a recession and between 30% and 50% declines every single time this has happened. Now, there is a tricky part about using this specific kind of chart, and that is timing. Why is timing important? Well, I'll show you. If I actually look at the 2000 bear market, the yield curve actually began to normalize several months after the market had already topped. In 2007, the yield curve began to normalize exactly as the market topped. In 2019, we had a yield curve inversion and then normalization, and several months later, we had a several-month rally. Several months later, the market topped and then the crash began. Now, the yield curve actually began to normalize late last year. And since then, we did in fact see a multi-month rally until the market topped in February of this year. Now, the expectation now, just based on the historical data and statistics, is anywhere between 30% and 55% declines. That means the S&P 500 can go all the way back down almost the 2020 crash lows. And I'll show you what that looks like on the daily chart for the S&P 500, right? Let's take a look at what 55% declines look like from the top, right? We're now all the way back down to the bottom of the 2022 bear market, and we're still not at 55%. We keep going, we keep going, we keep going, and we are back all the way, nearly back to the bottom of the 2020 crash, as well as the 2018 tariff war crash. Okay, now this is the big picture. I wanted to start with this chart because this is the big picture. How do we know that this is going to repeat? How do we know that this is not different, right? We hear a lot that, okay, this time is different, this time is different. Now, based on my experience trading the market, looking at historical data for years and years and years, it's almost never different. And we have the data to back it up. So let's take a look at something else. Up top is the S&P 500 consumer staples, i.e. defensives, relative to the S&P 500. Right, it's a ratio chart, and down below is the S&P 500 weekly chart. What this chart basically shows us is that when we begin to see consumer defensive staples begin to outperform the S&P 500, especially when we break above the 50-week moving average, really bad things start to happen, right? As soon as we begin to break above the 50-week moving average, really bad things start to happen, right? Time and time again, we've seen this happen consistently. Now, let me show you an even more important chart. Down below is the S&P 500 relative to treasuries, long-term US treasuries. Up top is the S&P 500 monthly chart. And in combination, the three charts that I just showed you, the yield curve inversion and reversion chart, as well as the consumer defensives relative to the S&P 500. And now the third chart, this one. Now I use these three charts concurrently, and I call them the three horsemen of the apocalypse. And every single time, going back tens and tens of years, every single time, all of these three charts agreed we've had a crash and a recession. Every single time, all of these three charts agreed. So are they in agreement as of today? Unfortunately, the answer is yes. If you're enjoying this video so far, slap that like button, and if you watch all the way to the end, I promise you there's going to be an incredible surprise, and it's only for those that watch until the end, right? It is very rare to have all of these three in agreement, and I'll show you that right now, right? Up top is the S&P 500, down below is the S&P relative to treasuries, long-term treasuries, and every single time the S&P relative to the long-term treasuries has closed below the 10-month moving average, right? This is the bright green moving average. As soon as we close below it on a monthly basis, we trigger a crash signal. This was the last time we had this crash signal. It was in 2018, just as we had that tariff war crash, that Christmas Eve massacre. Same signal triggered again in July of 2014. And several months later, we had the double dip recession of 2014 and 15. Again, we had that in the mini recession of 2010, mini recession of 2012, and right before the 2018 financial crisis. Now, why do I have two solid red vertical lines and then I have multiple dashed orange lines? Well, these dashed orange lines is when this signal occurs in isolation, without the yield curve having inverted and then reverted, right? So when this signal occurs in isolation, it is a bearish signal. However, we tend to get anywhere between 15 to 20% down for the market. Now, when this signal flashes with the yield curve having inverted and then reverted, we get something much, much worse. We get an actual recession, right? The last time that happened was 2008, and the signal flashed 1 month after the market topped. If we take a look at what happened last month, it's the exact same story. The signal flashed exactly 1 month after the market put in the February top. So this is by no means a coincidence. So now we have the three horsemen of the apocalypse all in agreement. We have the S&P 500 significantly underperforming treasuries. We have consumer defensive significantly outperforming the S&P 500. Both of these are signs of distress and defensive positioning by big money. And we have a yield curve that has inverted and now is beginning to normalize. This normalization will be very rapid as soon as the Fed begins to cut rates at a faster pace. As soon as that begins to happen, you'll see something that looks like this. And every single time we had a very violent market reaction. So this is the big picture. Big picture is we are now at the beginning of a bear market. We're looking at a recessionary-led bear market, so an especially bad bear market. We're looking at anywhere between 30% and 55% declines before the market actually bottoms and before the recession actually ends. Now that's big picture, looking out anywhere between a year and 2 years from now. What is going to happen in the near term? Now, this chart will help us look at that. This is the NASDAQ. And if we connect the lows going back all the way from 2009, the bottom of the bear market, the financial crisis, we connect that with the 2020 pandemic crash, and we connect that with the 2022 bear market crash. And if we connect all of these, we immediately realize that we're getting very close to tagging that exact same trend line. And typically, when that happens, we get a bounce. Now, the difference now with the big picture in mind is that this bounce is not likely to produce a higher high because the market top is very likely now in. We are more likely to see a lower high. Something perhaps that looks like this, right? This is the left shoulder, head, and then the right shoulder, and that's it. We top and then we move back down, right? Now, this does look bullish in the short term, in the near term, perhaps medium term, looking out a couple of months. And that posits the question, has this ever happened before? And the answer is surprisingly yes. Take a look at this. This will shock you, okay? Just take a look at this. Oh wow, what do we have here? Does this not look almost identical to this? Right, we connect the 2002 bear market bottom. We tagged it once, twice, and then if I extend this trend line, we eventually break it, get a bounce, back test it again, fail, and then we get the actual crash. As of right now, we are in this kind of stage. We're still in this very early bear market stage, the first wave down. This is just the first wave down for the S&P 500. It's simply the first wave. We will have many more waves down. Okay, so what are we looking at now? Top to bottom, so far the market has lost about 20%. So let's take a look at the last two big bear markets and let's see what happened after we lost 20%. Okay, so this is the 2022 bear market. If I measure from the top all the way to this, let's see, June bottom, we lost about 24.7%. The result was, let's see, a 19% rally all the way to the 200-day moving average, this dark blue moving average. Right, so typically after we get 20% plus declines in a bear market, we'll get a huge counter rally, tag the 200-day moving average, and then get another wave down. Now let's look at the 2008 crash. And you'll soon find out that it looks almost identical. Look at this, top to bottom, right? Almost 20%. What happens next? We get a counter rally. Let's see, about 14% all the way to tag the 200-day moving average. It is rejected, and then we move back down, get the final push higher to the 50-day moving average. It fails, and as soon as that happens, we get the actual market crash. Right, so if we are in a bear market and all signals do indicate that we are now in a bear market, if that's true, if this time is indeed not any different, we're looking at a huge dead cat bounce that began as early as last Tuesday, which is what we expected would happen. As soon as I put out that video, we had that dead cat bounce. We rallied to 550. That was my initial target for this rally. In fact, I put out a note saying 550 is the next level of resistance. This was in the middle of that dead cat bounce, right? Let me zoom in, show you the chart. Right, so this is the chart that was in the middle of that bounce. I said my first target is 550. My second target is 575. Why 575? We'll take a look at this. It happens to be at the 200-day moving average. I did place a trade at the close of Tuesday to the upside. I ended up closing it around 525. You can pause and read and look at the charts here. This was the trade. It was a $700 trade and I ended up closing it at $2,500, which is about 3.5x or 250%. Now, the prior day I went short, right? This is the prior day. I opened a short position at the open right here. I closed it right after we filled this gap. Then I went on and entered a long trade here and I closed it here. So I shorted at the open of Tuesday, then entered long at the close of Tuesday, closed that after we rallied on Wednesday. Since then, I have not opened any new trade, and that's because I'm now waiting for that bounce back, and I'm looking for a rejection either at 550, or if this continues, I'll be looking for a rejection at 575 to enter my next short position. By the way, if you want to get my up-to-date market notes and analysis, you can join our trading community on Discord. This is what the trading community looks like. I post every single day in the live analysis section. My trades, I post all of my trades in this room right here. I also share all of the trade setups that I'm watching in the trade setup section. I also share weekly expected moves for the S&P and the NASDAQ in my watch list, as well as the stuff that I'm watching, including key market earnings and more. If you want to join the trading community right now, I do have a sale on. As a thank you to you all, I have a 45% sale on both the Ghost Legend and Living Legend membership if you go for the annual membership. I've also added one additional perk to the Living Legend membership, and that is if you sign up for 2 consecutive years. That means if you sign up for the annual membership this year and if you renew next year, you immediately get lifetime membership for free. That's for the Living Legend annual membership. If you sign up for the monthly Living Legend membership, you will get automatic lifetime membership after you complete 1 year and 3 months. So essentially, we've already seen the first part of this dead cat bounce. We've already almost hit 550. We're now consolidating above the 5-day moving average, this moving average. Going forward into next week, we will likely see this rally continue at least back to the top of this range, 550. Look at how we have seen significant reactions. Tagged it twice, acted as support. As soon as we broke through it, it is now acting as resistance. And as long as we stay below it, it will continue to act as resistance. So what I'm looking at right now as a minimum, rally back to that 550 level, perhaps another rejection, and then we move back down to undercut that Monday low, form the actual bottom for the dead cat bounce, and then rally back to 575 and form that final rejection. Now, that is not necessarily how this is going to play out. I don't know how it's going to play out. It is possible the rally will continue all the way to the 200-day moving average, reject, and then we break the Monday low. That is also possible. So we don't necessarily have to break the Monday low anytime soon. We could just simply continue to rally all the way to the 200-day moving average, eventually reject it, and then come back down to break the Monday low. But all of the evidence suggests that the Monday low will in fact break. And one of the key charts that does suggest this is the NASDAQ Cohen High Low Index. And every single time we've hit the 0.05 level, we soon found a bottom, but it wasn't the actual bottom, especially in a bear market. Take a look here, we hit that level, then we went on to make a lower low, and that ended up being the actual bottom. Again, hit 0.05, went on to make slightly lower low, that ended up being the bottom, again in October, right? Every single time that has happened. So the Cohen High-Low Index suggests that we will likely see that Monday low eventually break, whether that happens soon enough or later, doesn't matter, but eventually that low is likely to break based on the Cohen High-Low Index, as well as the long-term outlook that we are in fact in a bear market. Now, the level at which the market has already seen a bounce makes a lot of sense. It is very close to the all-time highs back in late 2021, right? The 2021 bull market highs, right? We simply rallied, came back down, back tested that level, right? That exact same level, back tested, and we're now seeing our first major bear market rally. And usually these bear market rallies will continue all the way to the 200-day moving average, and then we get more selling. So we're not at the end of this bear market rally. We're not at the end of this dead cat bounce. We are still in the middle of this, and I'll show you how I actually traded this week to give you a little bit more of an insight into how I looked at this. So I already talked about my targets, 550 and 575. Now, just before that dead cat bounce, that huge rally on the Trump tariff pause news, I actually placed a trade the day prior at the close, very close to the close of the prior day. And this was the logic behind it. I took inspiration from consolidation structures that formed during the 2020 crash, as well as the 2018 tariff war corrections. And I said that I think the lows of Monday need to hold at least for a few more days to convince enough market participants that it was the low, only for that low to get taken out later. That is the only way we actually get capitulation and significant bottoms in bear markets. In bear markets, the first bottom is almost never the actual bottom. We always come back down to break it, and that break tends to be the actual bottom. This has happened many times in 2022. Right, this is the initial bottom. We get a big rally, come back down, undercut it. This ends up being the actual bottom for several more months. Then we get our first major bear market rally. Again, same thing happened. Take a look at this bottom, right? Initially, folks thought this was the bottom. We rallied, came back, broke it, got our second bear market rally. Again, a lot of folks thought this was the bottom. We came back down, broke it. This ended up being the bottom for multiple months, and then we got our third major bear market rally in 2022. Again, the October bottom. We had this low, market rallied, then came back down, formed this bullish divergence, slightly higher low on the daily chart, significantly higher low on the RSI. That ended up being the actual bottom. So the initial low is almost never the actual bottom, right? It is usually the second low. Now, this is especially true in bear markets. In bull markets, that is not true. In bear markets, we get capitulation and then we make higher lows. We don't go back to break that low, right? We get capitulation and then we go on to make higher lows. We don't break that low. That is typically the case in bull market. As evidence suggests, we are in a bear market. So now, another very important note that I want to point out is that this Wednesday bounce was the second largest single day rally on record. The largest single day rally on record happened in 2008 during the 2008 crash. I'll show you exactly when that happened. It was exactly this rally, this day. That was the largest single day rally on record. What I wanted to actually highlight is that these huge record breaking single day rallies are almost never the actual bottom. These are never the actual bottom. We went on to make significantly lower lows after that. In fact, after that rally, the market saw a 34% decline. Now, the third largest single day rally on record was this. It was during the 2020 crash. It was this day, and again, it was not the actual bottom. It was not the actual reversal. We went on to lose another 19%. I made this simple chart to highlight that these large single day rallies are almost never the actual bottom, right? In 2020, we went on to lose another 19%. In 2008, we went on to lose another 36%. And so simply based on the statistics of those two events, as well as the long-term picture of the three horsemen of the apocalypse, the inverted yield curve that is now normalizing, as well as the fact that we are now seeing the NASDAQ follow almost to a T the exact same playbook that we saw just before the 2008 crash, right? We had this very clean trend line, tagged it, and we had bounces pretty much every single time. And then when we eventually broke it, we had the actual crash. So we're looking at a rally now up to 575 on the SPY, then the actual crash. And my gift to you all, the surprise for those that watched this video until the end, there's a secret discount link that brings the membership down by 50% to $27.50 per month. And you'll find the secret link in the video description, or if you simply go to upgrade.chat/MTM, that is Money Time Machine, upgrade.chat/MTM, you'll get this additional discount. This is an annual only membership discount. Next week, we don't have a lot of big economic data coming up, but we do have some important events, including a lot of Fed members speaking on Monday. We also have retail sales data coming out Wednesday, and then Thursday we'll have some housing data. And Friday is going to be off next week. It's going to be Good Friday. So Friday is going to be off. And typically in shortened trading weeks, the market tends to be more bullish rather than more bearish. In fact, I want to close out this video with the VIX. The VIX is up top and the S&P 500 is down below. Typically, the VIX will confirm a bottom as soon as we break below the 10-day moving average. So far, this has not happened yet. However, we closed exactly at the 10-day moving average at the close of this Friday. That means if we continue to see this rally continue all the way to 550 or 575, we will certainly see this 10-day moving average break. And next, we will likely see the VIX form a slightly higher low relative to this low in March. And that will be the top for this bear market rally. And that will set us up for the next big VIX volatility spike and the next big market leg down. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.